Chapter 6, we're going to talk about, this chapter is all about stocks. So we're going to talk about the why people love to invest in stocks, the returns they have, historical perspective on returns. We are going to look at the features of stocks, talk about all the different features. We'll talk about common stock value, dividends, stock dividends, cash dividends, reinvestment plans, dividend reinvestment plans, domestic and foreign stocks, and let's just talk about why most investors use stocks as a primary tool for investment, why they're in love with stocks. Owning a stock is like owning a piece of the company. However, you can't buy 100 shares of McDonald's stock, walk into McDonald's and say, I'm an owner of this company, I'd like a free hamburger. Which you could do if you actually own the franchise, and you could go into the franchise as the actual owner of the franchise and say, I want my free hamburger. Because then they recognize you're the person who can fire and hire people and promote them. I'll give you whatever you want, you own the business. But if you own a piece of stock, you technically own a piece of the business, but you have no real operating power in the company. Unless you own a majority of the stock, 51% or more. If you own 51% of any company stock, then you can call the shots and make the decisions and get some free hamburgers. But that's very expensive. You would need billions of dollars to do that in McDonald's case. However, being a residual owner of a company by owning their stock does give you the benefits of dividends or the increase of capital gains and stock price increases. And that's really why we're invested in stocks. And today more than ever, in the last 50 years, stocks are paying a more consistent dividends. And one of the reasons is that since interest rates are so low, and we just went into the new month, and if anybody has a bank statement or a checking statement, you may have seen some interest on your account in cents, maybe a few dollars. And that return, you could have $30,000 in your savings account, and you look to see what your interest is for the quarter, and it's $5 or less. That stinks. So that's why people are interested in the stock market, because I can bring my money there and get a 3% dividend plus the chance of the stock price going up as well. So you can get additional return from two sources. So if your goal, like anybody's goal, is to increase your wealth over time, stocks historically have gotten you there the fastest. As far as bonds, real estate, just about any other investment, in its totality, stocks have had the highest amount of return, and it's also been the best hedge against inflation. Now, I'm not saying that it's, a smooth ride. There's a lot of bumps along the way. There's a lot of years where stocks go down tremendously. Just recently, we had stocks plunge 50% of their value, only to go return that amount of loss plus some in the past 5 years. What's really interesting right now, we've had a long bull run, so how much longer are stocks going to go up? Well, with the economy doing well and oil prices now going down and energy efficiency looking better, that could be a couple more years of bull market returns before the stock market turns down. Or there could be a small correction and the stock market could continue higher. The point is, we really never know exactly what the stock market is going to do the further out in the future we get. If we're looking at it in terms of years or months. But in long periods of time, we know that stocks, especially if you take a 10-year period, are always going to have a decent return. That's a long enough period to smooth out any ups and downs of the stock market gains and losses. And throughout time, you can see that the individual returns on dividends versus the total return, we had one decade that was really horrible because we had two major stock market crashes in the 2000s. This is probably the decade you grew up in, right? And okay, so we had a negative 1% return for that 10-year period. That's the first time that's happened since the 30s. And overall, the past 60 years, we've had 11% return in the stock market. But the 90s, we had a tech crash. In the beginning of the 90s, I'm sorry, the 2000s, we had a tech crash. And then then we had an accounting scandal where everybody was falsifying their accounting books, and the auditors were in collusion with the companies. We had a big Enron-led stock crush of 2003, and then in 2008 we had the Great Recession. So you can see why the 2000s were a terrible decade for stocks. But since the 2000s, we're in the, I don't know what you call this decade, the teens? Well, this decade stocks have been doing pretty well. In fact, going up tremendously. So this could be a decade. Generally, if you have a decade where stocks have gone down, have gone poorly, it makes it up in the following decade. So I would assume that these next, up until 2020, investing in stocks is going to be an overall good deal for everybody. We may have a year or two in the middle that doesn't do so well, but overall this decade should return value quite nicely. Now the 80s and 90s, we had very high returns, 17 to 18% total returns for those 2 decades. And that's what I expect to see in this current decade that we're in, to have average returns that high. The average investor, though, you know what their return is going to be? Well, let's say the average mutual fund investor, you know what their return is? Generally 2% in the 80s and 90s. So the market return, 17, 18%, the average person who invested in mutual funds only got 2%. And the reason for that is they typically buying high and selling low, buying the hot mutual fund, selling when the mutual fund is not doing well, or not buying, just being impatient and trading too vigorously of the mutual funds that they hold. And, stock market crashes, they sell everything, I'm done with stocks. Stock market starts doing well, they go back in at the high point. These common mistakes have led a lot of people to do poorly in their overall judgment of buying and selling stocks. So typically, the safest time to buy stocks is when the stock market is down. A good deal. And the riskiest time to buy stocks is when the stock market is much higher, like it is today. But the secret is, buying stocks at any time, as long as you're going to hold them for a longer period of time, is a good time to buy stocks. Okay, so in the last serious stock market, one-day crash, or where the stock market crashes in one day, now it's sort of like a crash in slow motion that happens over many days and many weeks. But because of these things they call the circuit breakers, they put in the exchanges to prevent one-day panics and absurd crashes. And the last time that happened was in this very month of October in 1987. Was the stock market went down over 25% in one day. What is the Dow at right now? Just a quick estimate. You should know this if you're in the investment class. This is also a question they may ask you on job interviews for financial companies. What's the Dow currently at? Anybody? Okay, 17,000. If we lost 25% of the Dow, how much would it go down in one day then? We'll say like 4,000 points. Can you imagine Dow going down 4,000 points in one day? Well, that's what happened in 1987. That won't happen again because they put circuit breakers in place to kind of prevent that. But stocks can be scary. That's the point I'm trying to make. And you can see this is an interesting chart where we're looking at, in the red, we're looking at the stock market index, and we're also looking at housing prices. And you can see that in the decade of the 2000s, we had this terrible event where stock prices and housing prices went down at the same time at similar percentage levels, which is really devastating to a lot of American families who saw their assets decline greatly. So it's sort of the lost decade for investing. So that's why the future, this decade and the decade after it, housing prices should return generously as well as stock prices to kind of make up for what had happened over the last decade. So if you look at the returns, There's actually the stock market returned 15%. There's one estimate, I guess, is a little different than the other. Oh, capital gains, not including dividends. That's why it's a little bit lower. It's 15% in the 90s and negative 2.7% in the last decade. This is without dividends. The other percentages I was showing you in the previous chart was capital gains and dividends together. But just straight capital gains, it looks even worse that last decade with a negative 2.7% return. Now, dividends were a lot higher in the 50s and 60s, dipped lower in the 80s and 70s when they were overtaxed, when dividends were taxed equal to income. A lot of companies stopped giving dividends, but then since in the 1990s and the 2000s, the taxing of dividends have been reduced, which we went over in Chapter 2, or at least Chapter 1, has brought back a lot of companies to pay more dividends. So the dividends actual paid to investors are on the upswing. That was just more of what I had said before. Now, a bear market is something that we're all afraid of at this point, because we're all kind of sort of like, I can't believe my good luck. Since 2009 to 2014, 5 years, stocks have gone up a great deal every year for 5 years. That's a terrific bull market, and stocks are up like 100% from where they were in 2008. So 2008 or 9, the Dow was, like 7,000 something, 8,000, and now it's over 16,700. So it's over, 100% return. So a routine decline of 5%, even this has been rare in the last couple of years of our stock market to go down 5%. Correction of a full 10% hasn't even occurred in a long time. So, but the market goes down 20%, then it's a bear market, and that does happen frequently. But we haven't seen it in a long time. So a lot of investors are feeling like, I'm not sure if I want to continue to put money in the stock market because it seems like prices are very high. But that could be a mistake, because back in the 90s, you may have felt that way in 1995 when stock prices did very well for a number of years and we had a long bull market in 95 and 96. But if you felt that way and kept your money out of stocks, you would have missed the biggest movement on stocks between 95 and 2000 that has ever occurred. You would have missed like the 5 best years in the stock market in all time. So sometimes even though we're at the peak or at a really good expansion point, it doesn't mean that there can't be another 4 years of expansion in stock prices. It's just really, you don't know fully. And right now, with the economy looking better, with inflation under control, unemployment going lower, oil prices going lower, it does look like we could have another really good year in stocks. So we're holding off the bear market. But the longer, though, it seems that we go with these bull markets, the more years, the worse the correction is when it comes. Because we tend to get into a phase where people get over-exuberant. The coin of Fed Chair Greenspan. And they just start putting everything into stocks very aggressively. These are the small investors. They move into once the small investors move in, they're throwing all sorts of crazy money in the stock market, and valuations go out of control. And that's what happened in 2000. All the smart money, all the educated investors will have their money out of the stock market by then. And then the market will crash, and these people will burn, and they'll sell everything as quickly as they put their money into the markets, in their sphere. Fear is the one thing you really have to be worried about when trading stocks in the real world. Okay, let's switch to a more positive note here. The advantages of stock ownership is you get higher returns, is what we've been discussing. Over the past 100 years, the stocks have returned nearly double of what bonds have returned. Interestingly enough, though, I also invest in bonds. I'm not just 100% stock. Because of the diversification we talked about in the previous chapter, I'm scared too, and I do have fear myself, and I don't think I would ever put 100% of my money in stocks. It's not that I don't believe in stocks, I just believe in diversification and a little bit more of a conservative portfolio. Perhaps more than you because I'm older. You can have the luxury of having a more aggressive stock-only portfolio because you have 50 years before you retire. You're not retiring until you're at least 72, based on current economic trends. But don't worry, you'll live to over 100, based on current life expectancy expectations. When my parents were born, their life expectancy was like 54, and now it's like close to 80. I'm not sure, but it's definitely close to 80, some number around there. So almost doubling of the lifespan in this last 100 years of the century. So, and your children, by the time your children get around to being middle-aged, there'll probably be whole new clone bodies they can put their consciousness into it so they can live, hundreds of years. Not going to happen for you, I'm sorry to say. Or for me, but, your children or maybe your grandchildren could possibly have this luxury. That's if the Earth doesn't dry up like a raisin from all the carbon we're shooting into the atmosphere. If you guys don't solve this problem, seriously, it's on you. I may have created it, but you need to solve it. I'm all out of ideas. My ideas were just to burn more fossil fuels to expand the economy, and that was not a good idea. You need the new ideas. So inflation is what we worry about with stocks the most, and investments in general the most. And stocks generally exceed the rate of inflation most easily over any other asset class. Easy to buy and sell. The price information and data on information and financial parts of companies are really easy to get on any website, financial website. And the cost of stock ownership is low enough now than it's ever been. In fact, a couple of students were telling me about this Robinhood stock exchange where free trades, pretty much. Don't read the 15 pages of the user agreement, though. There's probably some costs in there somewhere, right? Do you read your user agreements on when you get your credit cards or your iTunes update? Who has the time? Anyway, so you can, even if Robinhood is something, it's a stock trading site where there's zero commissions. We can't get access to that yet, but there is other stock trading sites where it's under $10, $7 or so, Scotch Trade and different very bargain oriented. So the cost of owning stock is much lower today than it's ever been. And we realized from the earlier chapters that stocks are subject to all different types of risks. And that's why you have such volatility in the stock market between the risk of the business, the risk of financing the business, the risk of inflation in the market, and different events that can occur. These are all different risks that can affect your company. And that's why the prices of stocks change so quickly. And it's one of the reasons stocks are hard to predict as far as, the price that you're going to make, the profits you're going to make, and when you're going to make them on stocks. And one other disadvantage is that there's a relatively low amount of income. When I say income, I mean dividends. Bonds pay a more consistent dividend. Some bonds pay monthly dividends. So wouldn't we all like have enough money in bonds where, say, they give you $5,000 a month in interest? Wouldn't that be great? Could you live on that? $5,000 a month. When you're a college student, you might say $5,000 a month. I could totally live on that. But then when you get to be older and you rack up all the things society says you should own, fancy cars, nice houses, dishes, mattresses, dining room table, children, $5,000 a month seems impossible to live on, right? But the secret is to always live below your means. Spend less than you make, which is very hard when you're a college student and the whole academic industry is looking at you at one big fat dollar sign. Textbooks, software, classroom, even university fees, commuting fee, computing fee, student activity fee, recreation fee, meal points. It's got some meal points that treat me to lunch today. I'm just kidding. That would not be appropriate. Not that you're treating me to lunch, but that the food here is just not appropriate. Okay. The current income, this is dividends for stocks and bonds. You see that in the red, the bonds have always paid more than stocks. Although they're closer today than they've been in a long time, because of the rising dividends. The lowering of interest rates have lowered the overall dividends of bonds, and the better tax environment has increased the amount of dividend stocks pay. So they're a lot closer today than they've been in many years. In fact, you could build an income-related stock portfolio that comes close to certain bond portfolios. So stock is what we would call equity capital. So this is ownership of common stock is oftentimes called equity or equities. So on a talk show about stocks, the trader may be talking about equities. I feel equities are going to do this. He just means stocks. And most stocks are publicly traded, although all companies have stock. Only some are publicly traded. And the publicly traded stock is the stock that you can buy and sell in the open market. And we talked about public offerings, IPOs, where they decide to bring their company public. A rights offering is when an already existing public company wants to sell additional shares. So if you own 10% of the company and they want to sell more shares to the public, they will actually tell you, listen, we're going to open up more shares. Do you want to maintain your 10% ownership and buy 10% of the new shares being offered? That's a rights offering. So you can maintain your ownership. Because what if you own 51% of the stock and they're gonna issue a huge amount of new shares? All of a sudden, you no longer control the company. So a rights offering helps people who have percentage ownership to maintain the percentage ownership of the company. There can also be a stock spinoff, where company decides. This recently has been talked about eBay. Carl Icahn is pushing eBay to spin off what? PayPal. Right? I use PayPal. I love it because it's an extra level of protection. Dealing with some of these flaky websites, it's like, all right, I don't want to give you any credit card information, so I'll just pay you through PayPal. Right? I mean, I think it was invented for porn sites. No, I'm just kidding. Can you use PayPal on porn sites? I wouldn't know. Okay. But it unlocks a certain amount of value. So eBay can break off and make PayPal public company on its own. If you own eBay, after this happens, you'll own eBay and PayPal. Although if they break PayPal out of eBay, say eBay is $50 a share, they break PayPal out and they trade at $20 a share, now eBay is only be worth $30 a share. So it's not exact like that, but generally you will lose value in the main company when you break off apart and make that a separate public company. But as an investor, you own both, so you're good. The idea is that eBay is a slow-moving stock now, but PayPal can move a lot faster. So, because all the money right now is in financial transactions. That's why Apple's new iPhone has a new Apple Wallet. It's going to do financial transactions, and everybody wants a piece of your transactions. More and more transactions are online, so PayPal has more potential than eBay, believe it or not. So, these stock spin-offs can occur. It's sort of like, ever watch TV? You're a fan of NCIS or Law and Order? And what do you see? Or CSI? You see all these spin-offs, CSI Miami, NCIS, Los Angeles, maybe New Orleans this semester. Oh, so the similar idea. We're just breaking things apart, making two where one stood. Now, a stock split is something different. We're not splitting off a company. We're not doing a what we call a stock spin-off. We're splitting the stock. So we're splitting the shares of the stock. Got 2 minutes. Splitting the shares of the stock. So if you had 100 shares and we have a 2-for-1 stock split, you now have 200 shares. If we have 100 shares, you have a 5-for-1 stock split, you now have 500 shares. But, well, wait a minute. It's not as good as it sounds. If you had 100 shares for $1 a share each, so So you paid $1 per share, and you had 100 shares, and they do a 5-for-1 stock split. Well, now you have 500 shares at 20 cents each. So did you make any money? No. When companies do stock splits, you don't make any money. You just have more shares. But some stock splits can be in reverse. You can have a 20-for-1 stock split. So you had 20 shares, 20-for-1 reverse stock split, now you have 1 share. AT&T did this most recently, and a couple of companies, generally when their stock price is too low and they're worried about being kicked off an exchange, or it's just a negative connotation to have a stock price below $10 a share. Companies will do a reverse stock split to get that stock price higher. Yes? What do you mean a fraction of a share? No, they would just pay you out in cash. So that you can't have a fractional share. Unless a broker decides to break shares up among its clients, they can do that. But if they're going to if it's coming out as a fractional, they'll give you the dollar equivalent to bring you to the next, round you down to the next whole number. Okay, so we'll pick up next class after this slide. I'll see you on Wednesday.